Dear friends, we shall now study chapter 12. The chapter is Legislation and Client Advice. What are the various act provisions which the agent has to know in order to correctly advise his clients? That we are going to study. And what are the learning objectives? Provisions of key legislation relevant to life insurance agents in providing client advice. In the insurance acts which have been passed, what are the provisions, what are the sections which are relevant to agents, so that you can give the correct advice to your customers? First, A. Indian Life Insurance Companies Act 1912. B. Insurance Act 1938. C. Life Insurance Corporation Act 1956. D. Insurance Regulatory and Development Authority IRDA Act 1999. E. Prevention of Money Laundering Act PMLA 2002. F. Management Property MWP Act 1874. G. Other key legislation. These are the various acts we are going to study very briefly, so that the agent can give correct advice to his customers. First and foremost, Indian Life Insurance Companies Act 1912. Actually, the first life insurance policy was issued in 1818. After nearly 100 years, the government saw the need to have a separate act for life insurance companies. Why? All these days they were simply going by the Indian Companies Act, but they found out that life insurance companies require a separate act because there are some special difficulties which have to be taken care of. For example, for any insurance company, as on 31st March, if you can prepare the profit and loss account and the balance sheet, you will know whether there is profit or loss. But life insurance companies are not like that. This is because we issue long-term contracts. We go on issuing policies, we go on collecting premiums, but are we solvent? Are we in a position to pay all the claims as and when they arise? This we have to check up at frequent intervals. What is called actuarial valuation is the job. So like that, some special problems are there for life insurance companies, and the first and foremost act was passed in 1912. Indian Life Insurance Companies Act 1912 was the first piece of legislation relating to the insurance industry. Then came the Insurance Act of 1938. The Insurance Act of 1938 is the most important and the most exhaustive piece of legislation regarding insurance matters. Actually, all the earlier acts were repealed, and this contains the provisions of all the previous acts. And it has been amended quite a number of times, but still 1938 Act is our basis for all matters which concern life insurance activities. B. Insurance Act 1938. The Act consolidates the law relating to the business of insurance, and it was the first piece of legislation to govern all forms of insurance, providing state control over insurance business. Until 1999, the controller of insurance, a person appointed by the central government to exercise all the powers, discharge the functions, and perform the duties of the authority, was responsible for administration of the Insurance Act 1938. The controller was replaced by the IRDA. So, after 1938, the government appointed a person called Controller of Insurance to administer the provisions of the Insurance Act 1938. The Insurance Act of 1938 has so many provisions, and somebody has to check and see if they are all being implemented or not. For the purpose, they appointed the Controller of Insurance. But now, with the IRDA Act being passed in 1999, the Controller's place has been taken over by the IRDA. Provisions relating to agents. And in the 1938 Insurance Act, what are the various provisions which relate to the agents? Section 41. Prohibition of payment by a way of commission or otherwise for. Prohibits payment of any form of commission to anyone except to a licensed insurance agent or an insurance intermediary. The point is, insurance agents or other insurance intermediaries are there to procure business, and they will be paid the commission for that. You cannot pay any other person who is helping you directly or indirectly to get business. The business procuration, the commission for procuring business should be paid only to licensed insurance agents or to other insurance intermediaries, but not to any other person. Section 41(1), prohibition of rebates. There is a very unhealthy practice of the agent passing on part of his commission to the customer or he is trying to share his commission with the customer. That's not a healthy practice, but that is there in the industry. So that has been prohibited, and the person who is receiving that amount and the person who is paying the amount, they are both wrong and they can be penalized. So this section prohibits rebates agents give. Agents should not share their commission with the policy holders. The commission paid to the agents is for their exclusive use. They should not part of it with the customers. Section 42, licensing of insurance agents. This is the most important section as far as insurance agents are pointed. What are the qualifications necessary? Is there a test to decide whether a person is a suitable agent or not? And what are the rates at which the commission is to be paid to them? All these things are mentioned in the section 42, which deals with licensing of insurance agents. Then other provisions relating to agents. Section 44, prohibition of cessation of commission. If an agency has been terminated, either because he has not been able to do sufficient amount of business, or on health grounds, or any other reason, even then under certain circumstances, he has to be paid commission. You should not stop paying the commission to the agent just because his agency has been terminated, but some conditions are there and they are to be satisfied. For example, even after the termination of agency, the renewal commission is payable to the agent except in case of fraud, etc. The conditions to be satisfied are the agent should have served continually and exclusively for at least 5 years, and a minimum business of 50,000 procured by him is in force for 1 year before his ceasing to act as an agent. So the agency should have run for 5 years. Second requirement is at least a minimum amount of 50,000 of business should be in force for 1 year. Then he is eligible for renewal commission, and of course the renewal commission rate should not exceed 4%. Second condition, the agent has served the insurer continually and exclusively for at least 10 years, and after his ceasing to act as an agent, he does not directly or indirectly solicit or procure insurance business for any other person. If the agency has been in force for 10 years, there is no requirement as to the minimum business in force and all that. He can be paid it, but on one condition, after the termination of his agency, he should not directly or indirectly help anybody who is procuring life insurance business. So if these two conditions are satisfied, he is eligible for renewal commission even though his agency has been terminated. In case an agent dies after satisfying the above mentioned conditions, the renewal commission will be paid to his nominee or legal heirs. Supposing an agent has satisfied the conditions and he dies, then his nominee or his legal heirs will be paid that commission which is due to him. That is called hereditary commission. Then C. Life Insurance Corporation Act 1956. This act provided for nationalization of life insurance business. In 1956, at least 245 life insurance companies were there doing a lot of business. But unfortunately, some malpractices were there, and the government thought that the matter should not be in the hands of private companies. So they decided to take over life insurance business. They wanted to nationalize life insurance companies. This act provided for nationalization of life insurance business in India. 245 companies were taken over by central government. The existing business was passed on to LIC of India. Life Insurance Corporation of India came into existence with the formation of the Act. So it is a statutory body. And the business of the 245 companies was passed on to LIC of India. Section 30 gave LIC the exclusive privilege to transact life insurance business in India. Section 30 of the LIC Act states that LIC shall enjoy monopoly in transacting life insurance business in India. That means no other company should be there in existence. Only LIC is given the monopoly to do life insurance business in India. This monopoly was broken in 1999 when IRDA Act 1999 was passed. So from 1956 to 1999, LIC was enjoying the monopoly for life insurance business. No rivalry, it had no rivalry, no competition and all these things. But in 1999, when the IRDA Act was passed, the monopoly given to LIC was taken away. D. Insurance Regulatory and Development Authority Act, IRDA Act 1999. The Act provided for the establishment of the IRDA as a corporate body to protect the interests of holders of insurance policies, to regulate, promote and ensure orderly growth of insurance industry, to take care of other related matters. IRDA took the place of the Controller of Insurance. An individual was there, Controller of Insurance, right from 1938. He was administering the provisions of the Insurance Act 1938. Now his place has been taken by IRDA as statutory body, and the objectives of the IRDA are the Act to protect the interests of policyholders. Customers' interest is always paramount. To regulate, promote and ensure orderly growth of the insurance industry. IRDA is the regulator. Just as the Reserve Bank regulates all the banks, IRDA controls all the life insurance companies and general insurance companies, both private and public, to take care of other related matters. These are the responsibilities of the IRDA. IRDA replaced the Controller of Insurance in administering the provisions of the Insurance Act 1938. Right from 1938 to 1999, the Controller of Insurance was responsible for administering the provisions of the Insurance Act 1938. Now the job has been taken over by the IRDA, laying down regulations for the proper conduct of business. IRDA has been giving some guidelines from time to time to see that life insurance business is transacted in a proper way. Number one, for example, claims. If a claim arises, what is the time before which it has to be paid? If all the papers are received, the claim payment should be made within 30 days. Like that, so many restrictions have been brought by IRDA. So many guidelines have been issued. Protection of the interests of the policyholders. The interests of the customer are most important. So IRDA always looks from the angle of the policyholders. Are they getting their due? The IRDA consists of whom? Composition of IRDA. A chairperson. A chairperson is there. Not more than 5 whole-time members and not more than 4 part-time members. So some 10 people are there in IRDA, and they they meet frequently and decide what else is to be done. It's a corporate body. A chairperson, not more than 5 whole-time members and not more than 4 part-time members. All the members are of course appointed by the Government of India. Then, Prevention of Money Laundering Act, PMLA 2002. Money laundering is a recent evil. So to take care of the bad effects of the money laundering, the Government of India has passed the Prevention of Money Laundering Act 2002. The act was passed to control money laundering activities. We will exactly see what money laundering is. These activities are to be curbed. Number 2, to stop financing of terrorism. Terrorism is a global problem, and finances were reaching those people indirectly through this money laundering. So they have taken all precautions to see that money laundering is stopped and financing the terrorist activities is also stopped. Money laundering, the process of bringing illegal money into the financial system by hiding its illegal origin so that it appears to be legally acquired. Illegal money is so placed that after some time people think it is legal money. So you are hiding the source of the illegal money and trying to make it appear to be legal. That is what is meant by money laundering. How is it done? There are 3 common stages of money laundering. 3 stages are there. First, placement. It involves the physical placing of cash obtained from illegal sources. What all money has been illegally earned, it is invested in a number of places. That is called placement. Second, layering, separating illicit proceeds from their source by creating complex layers of financial transactions. They indulge in a number of financial transactions so that the source of the money is forgotten. The source of the money is lost sight of. Nobody knows from where this amount has come. Lastly, integration, creating the impression of an apparent legitimate explanation for all the illegal proceeds. Lastly, by integrating all the pieces and all that, they make the illegal money appear to be legally earned money. This is money laundering. This has to be checked at any cost. Life insurers and all financial institutions are now implementing the KYC program. KYC program is Know Your Customer program. Formerly, anybody can open an account and deposit lakhs and lakhs. We do not know who he is, how he got the amount, and for what purpose the amount is going to be used. But now banks and life insurance companies when anybody has come to a bank or a life insurance company, we should know his address proof also, identity proof also. So, all policy holders should provide their identity proof and address proof. This is necessary at all the stages, namely issuance of policy. When you are taking a policy, you have to give the identity proof also, address proof also. Top up stage, when you are paying more and more premiums, especially heavy premiums, every time they have a right to ask you about your identity and also the address. Lastly, claim payments, when the policy has matured or become a death claim, at the time of payment also we want to make sure about the identity of the person and also the address of the person who is dealing, who is our customer. So KYC stands for Know Your Customer program. This also will help us to counter this money laundering process. Agents, what is the role of agents in preventing these money laundering transactions? Agents should understand the profile of their policy holders. You try to know your customer first. To whom are you selling a policy? You must know their profile. There are low risk customers and high risk customers. Low risk customers are salaried employees and government employees. Salary proof is there. So we know from where the money has come. It has come from the salary. You don't need to break your heads regarding the source of the amount. But high risk customers are there, regarding whom you have to be very careful. Who are these high risk customers? High net worth individuals, politically exposed persons, non-government organizations, NRIs, money changers, arms and explosive dealers, film personalities, persons dealing with real estate, antique dealers. These are all persons whose sources of income are not very clear. So the agent should first satisfy himself that all is okay before you deal with him. Agent should be careful when dealing with high risk customers. The customer's need for life insurance cover has to be verified. If a person wants a policy, what is his need for the policy? Without a proper need, if he is taking a policy, there may be something wrong. So you try to find out what is the need for life insurance cover. The customer's source of funds and their estimated net worth needs to be verified and properly documented. You have to obtain documents regarding the customer's net worth also and his income also. Lastly, premiums can be paid in cash only for amount not exceeding 50,000 rupees. Premiums above this need to pay through check, demand draft or through credit card. If I want to pay my premium of 1 lakh, I cannot go to the cash counter and pay 1 lakh. They will not accept cash. Cash will be accepted only if the premium is below 50,000. If the premium is 50,000 or above, you have to pay it by check or credit card or demand draft, so that we know from where the amount is coming. Then, Married Women's Property Act 1874. What is this Married Women's Property Act of 1874? If a married man takes a policy on his life under section 6 of the Act for the benefit of his wife and children, the policy shall be deemed to be a trust. The policy monies cannot be claimed by the policy holder, his creditors, court attachments and so on. Now, a person has taken a policy on his own life for the benefit of his wife or children or wife and children, and he mentions there that he is taking the policy under section 6 of the MWP Act 1874. Immediately the policy monies become trust money. What happens if the policy monies become trust money? The policy monies cannot be touched by the policy holder also, or by his creditors, or by any court attachment order. All these things they cannot touch. This is the property of the wife or children or wife and children. So that is very important. Who can take out the policy? Any married man. He can be a widower also, a divorcee also. Any married man can take a policy on his life and state on the face of it that it is for the exclusive benefit of his wife and children. It can be only for the wife, it can be only for the children, or it can be taken jointly both for wife and children. Anything is possible. Now, because it is a trust money, there should be trustees. Trust money has to be dealt by trustees only. So, you have to appoint the person who is taking an MWP policy, a Married Women's Property Act policies. He should first appoint some trustees also. 2 or more trustees have to be appointed. And he should also, he can reserve the right to change the trustees also, or supposing a trustee is dead, he can appoint a new trustee in his place. So, after the policy becomes a claim, either by death or by maturity, amount will be paid to the trustees Even if the policyholder is alive on the date of maturity, it will not be paid to him. It will be paid only to the trustees, because that is not his property now, that is the property of the trust. And the trustees will pass it on to the beneficiaries. That is the process. Supposing the person has not appointed a trustee, or he has appointed a trustee but the trustee has died, or the trustee has become insane, what is the position? The official trustee of the state, he will take over the matter, he will receive the proceeds of the policy, and he will dispose of them according to the terms of the trust. That is the procedure. So, then there are some other act provisions, other key legislation, we shall see what these are very briefly. Redressal of Public Grievances Rule 1998. Now, in the banking system there is an ombudsman, but prior to 1998 there was no ombudsman in life insurance industry. In 1998 the government decided that there should be an ombudsman for the life insurance companies also and for non-life insurance companies also, so that any complaint of the customer can be taken care of. Redressal of Public Grievance Rules 1998. The governing body of Insurance Council, GBIC, was established under the Redressal of Public Grievance Rules 1998. To take care of the institution of the ombudsman, they first formed the Insurance Council. Every insurance company will send a representative to that council, so that every insurance company is represented on the Insurance Council. The GBIC, governing body of Insurance Council, consists of one representative each from all insurance companies. The representative should be either the chairman or the managing director or a director of the company. He has to be a member of it. So, these people, they can appoint the insurance ombudsman and they can define his duties. One advantage in the insurance ombudsman system is, he always gives a solution in a time bound manner. He will give a solution either within 1 month or within 3 months. Second thing, IRDA, Insurance Advertisement and Disclosure Regulations 2000s. These regulations are designed to check unfair and misleading advertisements which make false claims and promise benefits which are not there. When a person is selling something, he is bound to exaggerate the advantages of the product. Like that, agents also may tend to speak very highly about a product. They may also mention benefits which are not there. To take care of it, these regulations of 2000 have been issued. If an agent wants to issue an ad, he has to first obtain the permission from the insurance company. They will check if all the benefits mentioned are okay, or he has just introduced them to attract the customers. So after getting the clearance from the company only, he can issue an ad regarding a product. But supposing he wants to give an ad regarding his agency, company's permission is not necessary. I am so and so, I have this qualification, I have been in the field for so many years, we take care of all your interests, please obtain policies from us. Such a thing, companies. But if you want to give an ad regarding a product, you cannot overstate its advantages and all that. So the company's clearance is mandatory before you can give the ad. Then how can premium be paid? Now there are so many new ways of paying the premium also. Formerly it used to be by cash, it used to be paid in cash or by check. But now he has given some extra channels also of making the payments. These regulations define the manner in which premium can be paid by a policy holder for purchasing an insurance policy. How? By cash, check, demand draft, pay orders, banker's check drawn on any scheduled bank in India, postal money orders, credit or debit card held in the policy holder's name, etc. So, he can make the payment of premium through any of these channels. Then, corporate agents are there in the industry. Who are corporate agents? Corporate agents are none other than institutions which have taken up a life insurance agency. Just as an individual takes up an insurance agency, an institution, a company or a firm also can take up an agency. A bank also can take up an agency, and that is called a corporate agency. So, the IRDA regulations 2002 regarding licensing of corporate agents, these regulations deal with the issue of licensing and other matters related to the corporate agents such as companies, firms, banks, cooperative societies who are not individuals and can still become agents. All the rules and regulations have been mentioned in these rules. Foreign exchange management insurance regulations 2000. Can an Indian take a policy from a foreign insurer? If you take like that, you have to pay the premium in dollars or pounds, and that means the foreign exchange reserves of the country will be depleted. So they said these regulations are exchange control regulations which govern issues of life insurance policies to non-resident Indians. The position is like this: no resident Indian can take a policy from a foreign life insurance company, because you will have to pay the premium in their currency, and the Reserve Bank may not be having adequate foreign currency reserves. The other thing is, an NRI is there. He has taken a policy in India because he comes here occasionally and goes. He has taken a policy. How are the premiums to be paid? Can he pay in the rupee currency, or should he pay only from abroad so that we get some foreign exchange? And how are we going to pay the claim? That question also we have to decide at the time of issuing a policy. The position is, if he wants to pay the premiums only in the rupee currency, no problem, we accept, but the claim also will be paid in the rupee currency only. If he has been paying the premiums from abroad, that is, our country will be getting some foreign exchange. If he has been making remittances from abroad in the foreign currency, the claim also we are prepared to pay in the foreign currency. All this we should make very clear to him at the proposal stage. Lastly, Consumer Protection Act of 1986. Consumers are customers. They have grievances. They bought a costly TV, but it was not functioning properly. They want to return it, but the shop people are not taking it back. He has an option to approach the consumer court. I bought this costly TV, it is not working properly, and I wanted to return it, they are not taking. So order them to take it back and replace it by a new TV. So some such thing. Customer Protection Act, COPA 1986. This act is designed to redress the grievances of consumers who complain against defective goods they have bought or poor services they have received. It's not only buying of goods, but services also. I was admitted to a hospital, they did not give me proper service. One hotel has been asked to arrange a party, my birthday party. They have not made proper arrangements. They have charged me heavily, but the service was very poor. All this I can take to a consumer forum, and they will redress my grievance. The consumer can complain to the consumer forums at the district level, state level, or national level, depending upon the value of the goods or services they are not satisfied with. For example, if the complaint is regarding an amount not exceeding 20 lakhs of rupees, you can go to the consumer forum at the district level up to 20 lakhs. Or some apartment was passed on to you, it was not in good shape and all that. If you want to complain, the cost of the apartment is 50 lakhs. So, state level above 20 lakhs up to 1 crore. You got a complaint regarding costly things up to 1 crore, you can approach the state level consumer forum. And if the value of the service or the goods exceeds 1 crore, you have to go to the national level consumer, you have to go to the National Commission at Delhi. The National Commission at Delhi, it also hears appeals against the decisions given at the district level or at the state level. They also directly receive complaints regarding services or goods valued at above 1 crore. They also hear appeals against the lower courts. So like that, they have made an excellent arrangement for customers to air their grievances and to get redressal for their grievances. Some questions and answers are there. We shall see what they are. Consumer forum at district level will hear complaints up to 20 lakhs or 40 lakhs or 1 crore or 10 lakhs. Just now we have seen 20 lakhs. Up to 20 lakhs, the district level consumer forum will take care of. So 20 lakhs is the answer. The controller of insurance in India is the controller or the regulator of insurance in India. Who is he? Is it the IRDA or RBI or SEBI or Insurance Ombudsman? IRDA is the answer. Formerly, prior to 1999, the controller of insurance was there, but after 1999, Act was passed in 2000. Only the IRDA, Insurance Regulatory and Development Authority, has been the regulator for all insurance companies, both life and non-life, both public and private sectors. Married women's property, if the policy is taken under MWP, then the beneficiaries are wife and is it parents or children or wife and children? Wife and children is the answer. Parents don't find a place in the MWP Act. So it can be children only or wife only or both wife and children jointly. So fourth option, wife and children is correct. Who controls monetary system in India? The monetary system in India is being controlled by whom? Is it RBI, IRDA, SEBI or Constitution? RBI, Reserve Bank of India. It takes all the measures necessary for the money system and all that. Then, which is the second stage in money laundering? Money laundering consists of three stages: placement, layering and integration. So layering, placement is the first stage and layering is the second stage. Integration is the last stage. He wants to know which is the second stage. Layering is the second stage. In the stage placement, the person who has got a lot of illegally earned money, he will invest it or place it in a number of places so that the big amount is broken up into small pieces and all that. Then they create a number of layers, illegal money, legal money, all these things are, so many transactions are there so that people are confused. You cannot distinguish between illegally earned money or legally earned money. And lastly, integration is the third stage. Integration, they integrate all these things so that the illegally earned money appears to be legally earned money. Next question. Which one of the sections deals with the licensing of an agent? Section 42 of the Insurance Act 1938, Section 42 of the Insurance Act of 1936, License Section of Insurance Act 1938, License Section of the Insurance Act 1938. First answer is the right answer. Section 42 of the Insurance Act of 1938. No Insurance Act was passed in 1936. So 1938 Insurance Act, that too Section 42 is the answer. So thank you.